Hi everyone, Darren Loads here from Insurance Advisor Net. Just a quick reminder to those that don't take advantage of the PI insurance facility that we handle for the members. Please keep us in mind when your policy is next coming due. The insurance market in Australia continues to be very volatile, with premium increases still in that 10 to 15% range, and PI insurance is certainly no exception to that. Fortunately, we were able to secure our premium rates recently with our insurer unchanged for another 12 months. So please keep us in mind when your policy next comes up. It's a pretty easy process to obtain an alternative quote. Our contact details are on the members section of the FBAA website, and we look forward to being of assistance. Take care. See you soon.
Heartland Seniors Finance is Australia's leading reverse mortgage provider. We have helped over 21,000 Aussies live a more comfortable retirement with independence and dignity with our award-winning reverse mortgage. Interested in living a retirement on your own terms, free from the financial stress of ongoing loan repayments? Call us on 1300 889 338 or visit our website to find out more about using your existing home equity to live a more comfortable retirement.
Upgrade from your existing Certificate 4 to a diploma with our recognised prior learning process. The recognition of prior learning process uses your current work evidence and applies it to the course subject requirements, meaning that you have no or very little assessment work to do. Call AAMC Training today to find out more.
Hi everyone, and welcome and thanks for joining us for our 2022 Learn and Earn session here in New South Wales and the ACT. I'm Paul Biddle, the New South Wales ACT State President for the FBAA, and I'll be your MC for today. This is our second Learn and Earn session for 2022. So please feel free as well to share your webcams, as this helps us all feel a little bit more connected. It is a little bit surreal going back to virtual worlds, but obviously it is definitely a little bit more convenient for everyone. There are 1.5 CPD points allocated for each Learn and Earn session. You'll receive an email after the presentation and a short survey. So please stay on throughout the whole webinar to ensure your attendance is marked off. We'd like to thank our sponsors for their continued support as always. Without them, we couldn't deliver these sessions. You'll get all their contact details in follow-up emails after today's session. FBAA members, please don't forget you will receive 10% off your membership for every time you refer a new FBAA member. Please also download our FBAA app. It gives you easy access to information, updates, and upcoming webinars to register for. Please don't forget also to access the FBAA members area, which has member benefits, resources, and tools to assist you. We'd like to congratulate and recognise our FBAA members in New South Wales and ACT listed on the following slides that have been with us between 5 and 15 years, or in some cases, just that little bit longer. Thanks for your continued support as members of the FBAA. FBAA recently started a community impact hub. This is a charity gifting portal that allows you to donate to charities of your choice to help support the community for those that are able to. Please see today's agenda. It's also in the chat box for you to download. If you have any questions throughout the session, please submit them in the chat box, and let's get into it today. So first up, we have Bluestone. So Lauren from Bluestone will be presenting for us on how alternate lenders can help your clients. Over to you, Lauren.
Thank you very much. I'll just share my screen. 1 second. Okay, can you see my screen?
We can, and we can hear you. Perfect.
Perfect. All right. Thank you so much for having me. I'm going to keep this short and sweet, guys, and just run through, rather than doing a product vlog with you, I'm just going to talk about how you would recognise any non-prime customers that you may have. Particularly after the last couple of years, we've seen that there's been a steady increase. And just to make sure that you are catering to all customers out there and what to look for and how to actually have the conversations with them. And any moment now, here we go. Okay, so what to look for. Okay, so it's really imperative, particularly when you're coming to a lender like Bluestone, where we don't credit score, to ensure that your notes and story about the deal are done really well. And that's why you'll engage your BDM and just make sure that we really understand the story. So what's brought them to this situation? Why are they here? Generally, if they're falling into a non-prime space, it's either going to come down to financials or a life event that has impacted them. That means that they're not fitting into your more traditional lenders. We then step across and look at their capacity. So if they are falling into, say, the credit impaired space, if they haven't been paying their mortgage, where is that money been going? What have they been doing with it? And again, that comes back to that story. Have they been investing their money elsewhere during that time? Tell us a bit more about it so we can really understand what's got them to where they are today. And then we look at the security. So we don't take risks on security, we take it on the applicant. Again, it's imperative that you go through not just the loan story, but also the security story with your BDM. Let's make sure that it's something that we are willing to take on board. And we will also be checking the suburbs that we're lending to, not the postcode. So again, we can help you understand what the appetite is for that particular type of property. So what is a non-prime borrower? So it can be any of these things. We've just gone into a new financial year. That means that there's a lot of self-employed borrowers that have come off the last sort of strange couple of years where their financials may have been up and down and may not necessarily be a true reflection of where they're at. So they may not have the financials in place already. So we'll move them into an alt doc product where we can provide less, be it an accounts declaration or BAS, which is a more reflective view on what their financial state is. We've got a huge amount of divorces going through. I remember seeing something on the news the other day. I think there's been a 20% increase during the COVID period of divorces. Lots of people getting bad advice just to stop paying, and subsequently it lands them in a bit of a difficult position when they're looking to refinance out. So we're happy to help those people as well. There's been lots of failures of business, and on top of that, a lot of unsecured debt being obtained during the past couple of years. We're all about helping those people get back on track and consolidating those debts and starting afresh. Again, you're going to have a lot of people that have gone through that over the last couple of years. Also, people that have got issues with credit files. So we don't credit score. So we do get a lot of people coming through for that particular reason as well. One thing that's super important when you're dealing with these customers is to talk about the repayment, not the rate. Because we're looking at doing things like consolidating ATO debt or various unsecured debts, it's really important to focus on the end dollar value that they're going to be looking at in a monthly payment rather than the rate, which I know a lot of people do focus on that headline rate. So just make sure you're using the tools that we provide you just to look at that end monthly repayment rather than that rate. Also, it's imperative to talk to them about the fact that this isn't a life sentence. This is just getting them back on track, consolidating, and just, well, this is take, be that 12 or 24 months in this particular product, we can streamline them straight across to one of our prime products in a process that takes sort of 2 to 3 minutes for approval. So it's really important when you're discussing that with them as to what that road ahead looks like for them. And when you're speaking to these customers, talk about the solution and the benefit to the customer. Again, it goes back to what that monthly repayment will be, not discussing that rate. Really have a true understanding about what caused them to be in this particular predicament that they're in, whether that was the failing once they're in a position where they've been embarrassed or not used to being a non-prime customer, you'll find that they are way more likely to refer you to your friends and family. The revenue there for your business will be obviously huge because you're not going to be saying no to anyone. And again, those referral sources are huge with these customers that don't fit into the prime space. Accountants and solicitors. These are the people that you're getting these customers from, whether we're paying out the OTUM. Solicitors, obviously, when it comes down to those divorces or arrears. Financial planners, if they're looking to increase their portfolio via their equity, and also the debt agencies. These are the 4 areas where we find the most referrals will coming to you. If you've got existing relationships with any of those, they will love the products that we have on offer. That was me at warp speed. So I've just gone through that super quickly for you just to see how you would pinpoint those non-prime customers. Are there any questions?
Hey, Lauren. Good. So there was a bit of audio there, so we apologise for that. It did break up occasionally, just for a couple of seconds. So every now and then. But for those that have further questions or need to reach out, I'm guessing they've got on their, each aggregator has their own BDM, and they can reach out. Is that correct? Or do you guys have state-based BDMs?
We do have state-based BDMs, but I'm happy for them to all come through to me, and then I can just point them in the right direction if I'm not the BDM that they deal with.
And some aggregators have white label products as well.
Correct.
The same BDMs, correct?
Yes.
Perfect. Done. We just have a couple of questions. I think they're being dealt with in the chat and stuff like that. So that's fine. That's pretty much it. Thank you very much.
Thank you.
Right, next up we have Cam from Strive Financial. Cam will be talking to us about why short-term lending. So over to you, Cam.
Hey legends, how are we all? I'm hoping everyone's good and staying dry and safe down in your part of the world. We're all thinking of you. Again, it's been a few times now in the last 6 months, so hopefully everyone's well. Thank you so much for having me. I won't take up too much of your time here. I know this Zoom stuff is very hard to get any sort of interaction. So if you do have any questions, queries or dramas, all our contact details are always with the FBAA. If you ever want to chat through any business finance deal, whether we can help you at Strive or whether I can hopefully point you in the right direction, please feel free to give me a bell. Couple of things I just want to talk about quickly around our short-term lending and that sort of space that we play in. There are a lot of people out there now that play in the space, and whether it be the unsecured stuff that's done off bank statements or done off cash flow finance, whether it's secured stuff like we do, where we don't look at the bank statements or their income, we're looking at security and an exit strategy. It's really important that you understand a little bit about how it works and why it works for clients. With everybody looking to diversify these days, there is a real opportunity in this sort of space if you've got the right client and you can find them the right solution. And a little bit like Bluestone was just talking about, it's simply solution-based lending. It really is. It's never about the interest rate. It is purely about the problem that you're going to solve and the solution that you can come up with, or the advantage that you're going to help your client take in either putting on new staff or winning new contracts or settling a house purchase or what have you. And that's where it's really, really important that our messaging to our clients is around those things, taking advantage of the opportunity or saving the day or having a solution for them. And then what the cost of that solution is. In our products, you're dealing with businessmen and women. So you're not dealing with mum and dad that have a PAYG home loan product. You're dealing with businessmen and women that have been running their business for a period of time, that understand the cost of the solution and what that solution gets them in their business. And as I say, whether that's more staff for a new contract that they've won, whether it's purchasing a competitor, whether it's having more stock, whatever it is. And the simplest way I can always bring it back for people to understand is around Ubers or cabs or hotel rooms or what have you. Now, we don't get an Uber every day of the week because it wouldn't be affordable. Where we do use an Uber when we need to get from point A to point B every now and then. And although it might cost 10 times what it costs me to drive my car, if I'm at an airport and I need to get to a meeting, I'm going to jump in an Uber and get there because I don't have my personal car to be able to do that. And that's the cost of the solution for me to be able to do that. If I need to stay 3 nights in Melbourne and I'm based on the Gold Coast, I've got to pay 3 nights accommodation, and it might be $500 a night. Well, that's the position that I'm in. It's the cost of the solution, and it's why I need to be able to do it. Short-term lending is no different. You are just trying to get your client from point A to point B. And as Bluestone was saying earlier, it is always about the story. It's really, really important that we understand why it's going to work for your client. So when you're talking to people in our industry, really, really important for us to understand what the exit strategy is, how it's going to help the client. In our situation, it's all our own money. So if we don't understand the situation that your client's in, and we don't understand how this is going to help them get from point A to point B, then a lot of the time you're going to get knocked back in this space where we won't be able to help you with the loan. But if you can tell the story of the client and why they need to get from point A to point B, and it's going to take 3 months to do it, or we need a tax debt fixed up, or we're doing a refinance, but we need this done before the refinance can happen, short-term lending's got to make sense. And if it doesn't make sense, it's actually no good for you, it's no good for your client, and it's definitely no good for the lender as well, because we end up with defaulting loans, which nobody wants to end up with. Listen, I've used none of these slides again because that's just how I end up rolling here, but let me quickly flick through here with a minute that we've got. It's about time, not the industry. A lot of people will say, oh, what industries will you lend to? As long as it's for business or investment purpose, but it's always around timing. If people have 6 weeks before they need the money, they're not going to use short-term lending because they've got time to go to Bluestone. It's always a timing issue, and whether that's 24 hours or 48 hours that they need the money, it's always about being able to solve a problem quickly for them. Again, we're either seizing the moment or saving the day. A couple of different reasons here why people would use it. And one thing that I talk to a lot of people is, what's the cost of not doing the deal? What's the cost of the client of not doing the deal? And when you start to look at it that way, rather than the cost of doing the deal, what's the cost of not doing the deal? And the client, as I say, they're businessmen and women. They will make that decision. If it's not viable for them, they won't take the finance. It's really, really simple. Thank you so very much for having me. I look forward to hopefully being back down there later in the year and doing this face-to-face where we can be a little bit more interactive. As I say, if you've ever got questions, queries, or dramas, please feel free to give me a bell. I'm always happy to have a chat.
Thanks, Cam. Thanks for that. And I'm guessing every situation is quite unique. So just reach out for you, run the scenario, and you'll say whether that's going to fly or not fly, basically.
Most definitely. Thanks, bud.
No worries. Thanks. All right. Next, we're moving on to ALI Group, and Shelley will be presenting Why Should People Be Insured? So over to you, Shelley.
Thanks. Thank you. I'll just share my screen with you. Hopefully you can see it.
Yep, we can hear you up now.
Have you got am I sharing the right screen? Have you got the
claim experience is what we've got up.
All right, awesome. So thank you everyone for taking time out of your business to listen to me a little bit today. I hope that everyone's safe, and if you are impacted by the flood, feel for you, and I hope that things get better soon. And if you're not, then all well. So if you've got any questions, please just yell it out. I really don't mind if you want to just take yourself off mute and yell it out. That would make it a lot easier. I feel like I'm not talking to myself. Okay, so basically today I'm just going to share with you a little bit about our claims experience. But first of all, I thought it would make more sense if I told you My Protection Plan actually is. So My Protection Plan is a product that is not actually lender's mortgage insurance and is often confused with lender's mortgage insurance. So My Protection Plan protects the borrower. It doesn't protect the lender. And so a lot of people confuse it because they think, oh, I'm sick, I can't make my mortgage repayments, or I'm in hardship, I'm about to default. That's okay. I paid LMI, or lender's mortgage insurance, so I'm covered. That's not the case. They need to have some other form of protection if they get sick. So this is what my protection plan is. It's an optional life insurance policy. It provides a package of 3 main benefits. The benefits are payable to the customer directly. It doesn't pay the loan, it pays them. They can then choose what they want to do with the funds. So the things it covers, I'm not going to spend too much time on, but basically the 3 main benefits: a death and terminal illness benefit. So if they die or are diagnosed with a terminal illness, it pays them the full sum insured. Cover is from 100,000 to 1 million. So, and the other 2 things it covers is trauma benefit. So it covers 17 serious medical conditions. The trauma benefit is 30% of the sum insured, and the sum insured is generally defaulted to the loan amount. It also has a specified injury benefit. So in Australia, 532,500 people are are hospitalised due to an injury every year. That's 500,000 people. The majority of those hospitalisations are due to fractures or breaks of certain bones. So what we do is we cover people in the event that they break one of those common bones, like arm, shoulder, legs, that kind of thing. Okay, so that's in a nutshell what it covers. First and days are complimentary. What I really want to get to though is, why would you actually do this? So what is the impact you can have to your customers? And I want to start by saying, never underestimate the impact you can have on a client if you offer them protection, they take it, and they need to use it. I'm going to share a couple of claim stories with you shortly. The other thing I want to share with you is, if you don't offer this product or this type of product or protection to your customer, it's likely that they will never get offered it. So unless they physically go out and find a financial planner or respond to an ad on TV, they're unlikely to ever be covered. So it's really important that you have this conversation with them, because if you're not having this conversation with them, who will? So ALI paid out $11.6 million in claims in 2021. 70% of those claims were for cancer, 9% were for heart attacks, 8% for strokes, and 1% for kidney failure. Age is no barrier to illness. So it doesn't matter how old you are, illness can happen to anyone. And so I'm going to share with you now a couple of the claim stories we have from 2021. So I'm actually just going to read these because I think they're pretty powerful. But Helen, who was 56, she claimed for cervical cancer. The benefit that was paid to her was $51,579. So she said, being diagnosed with cancer has been the most challenging experience, both physically and emotionally, of my life. Not having to worry about finances has made the journey easier and has been one less obstacle to cross. And then Chantal, who was 39, she claimed for colorectal cancer. Her benefit was $97,919. And she said, it was just nice to know that if one of us passed away, we knew that we could stay in our home and not have to worry about how we are going to pay our mortgage. We should have been in a really bad financial situation. So I'm very thankful that the broker offered us that many years ago. And then the third thing I wanted to highlight just on that is Susan. So Susan was 43. She was a single mum of 2 teenage daughters. She selected a cover amount of $100,000. So what I'm trying to highlight with these 3 claim stories is that you don't have to cover your full loan amount, that they can choose a level of cover that they can afford. So in this instance, Susan chose $100,000. Her monthly premium at 43 years of age was $28.90, okay, under $30 a month, under $1 a day to be covered. She claimed for breast cancer and the benefit she received was $30,000. That is, say for example, you had car insurance for $30,000, it's unlikely that your car insurance is going to cost you $28.90. So what's more important to you, your customers? Is it the car or is it yourself? And how are you even going to meet the requirements on your home if you are diagnosed with breast cancer and you need to take time out of from work to get better? So 2 years into her policy, Susan was diagnosed with breast cancer, and with the $30,000 Susan received from her she was able to focus on her treatment and recovery. She said, at one stage, I was going to cancel my policy to try and save money. I never got around to cancelling it, and I'm so grateful I didn't. I'm very lucky. Yes, I want to highlight to you that you don't have to take cover on your full loan amount. You can take cover on any amount that you like, and they choose the level of cover. Some cover's better than none. The only other thing I wanted to highlight quickly on this next slide is that 98% of ALOs, the survey, 98% of respondents said it was reasonable that their broker offered my protection plan when they took out their mortgage. Therefore, they're telling you that have this conversation, they're happy to have this conversation with you. And finally, it's a win-win. So you actually earn commission for this. So not only do you get peace of mind by offering the customer's protection, knowing that they're covered and they're winning because if anything happens to them, they're going to be covered, but you also earn a commission for it. And the commission is $1,600 per joint policy. And the conversation literally takes 10 minutes. So that is it from me for the moment. Does anyone have any questions?
Sure, Shelley, there was just one that came through on the chat. If clients don't have a mortgage, can they still apply for this type of insurance?
They sure can, yes. So they just need to have a mortgage or be seeking to take out a mortgage. So if they came to you and you declined and the loan declined, they could still take out this cover. They don't have to proceed with the loan. Any other questions?
No, that's it for now. So thanks so much, Shelley. We appreciate it. Next up, we've got, one second. We've got Brad from Finstro. So Brad will be talking to us today about using business credit for temporary and full expensing discounting.
Thanks, Paul. I won't share my video if that's okay, because I'm in a bad reception area and I'm told it will create a lag. So can you hear me okay?
We can hear you okay, and we can see your screen now, so perfect.
Terrific. Okay, terrific. Yeah, well, if whoever's driving, if you wouldn't mind just flicking through to the second slide. Just a very quick ad, because I know that's not the purpose of these things. Finstro provides trade credit and payment solutions within the context of business-to-business trade. In our experience, there's lots of problems inherent in business-to-business trade, and we aim to solve those things. And we've partnered with a large number of banks and technology companies as part of doing that, both in Australia as well as recently having launched in the US. But what I really wanted to talk about was slides 3 and 4. So I wanted to give you a simplistic example of how using business credit to purchase an asset. If you could just flick to slide 3, that'd be great. So, the Australian government introduced, as most of us might know, instant write-off for small businesses, and they have recently transitioned that into a what they call a temporary full expensing sort of policy. Just one caveat that we're not looking to give business tax advice here, but just rather give you everyone a high-level perspective on how potentially using credit to make a purchase of an asset that is eligible for the purposes of immediately being expensed can deliver favourable tax outcomes. So essentially, the temporary full expensing encourages investment basically by businesses in eligible assets, and eligible asset being an asset that is for business purposes and is installed in your business, as at 30 June 2023. In terms of, it can be a new asset, a second-hand asset, or in fact, an addition to an existing installed asset as well. In terms of the eligible businesses, it's pretty broad. For new assets, it's businesses turning over 5 billion and below, and for second-hand assets, it's 50 million and below. So what I've done here is I've just given a very simplistic example of a business turning over about $500,000 a year, so a small to micro business, before and after actually purchasing an asset that is eligible for the temporary full expensing. And in this example, a $25,000 asset, you either purchase it with credit or you purchase it without credit. And you'll see that the asset that's eligible will be expensed and reduce the tax liability, and also the cost of credit associated with borrowing to make a purchase of that asset are also generally deductible. So you can see here that businesses who may choose to use credit and to make a purchase of an asset rather than impacting their working capital can get significant tax savings. And so that's largely what I wanted to cover off there. The next slide is another interesting example of essentially something that's quite common in Australia and in the US, is where suppliers provide their business customers with early payment discounts for prompt payment. And I really just wanted to highlight here how using a working capital facility or a business credit facility to can allow you to avoid discounting as a supplier. And the other side of the coin, it could in fact, as a buyer, allow you to take advantage of early payment discounts. And I just wanted to really highlight the significance of some of these early payment discounts. It's not uncommon for businesses to essentially offer what they call sort of 5% in 10. So basically, if I give you a 5% discount off your invoice if you pay me within 10 days. Now that essentially can be something in the order of about 60% per annum implied cost. When you add on top of that other costs such as trade credit insurance and payment acceptance, it's a very high cost that a supplier is incurring to get access to those funds potentially only about 20 days early. And so having access to a credit facility to basically accelerate the payment of your invoices or get access to the cash faster can turn out to be significantly cheaper than actually offering payment discounts to your business customers. And I've just illustrated there what the magnitude of some of those savings might be. The flip side of the coin is if in fact you're a buyer and you wanted to basically get access to or take advantage of the early payment discounts that your suppliers or vendors might be offering you, using a credit facility to have the cash to take advantage of that could in fact also deliver you with very attractive net returns. And the example I've given here again is if you were to basically have your own capital, then of course you can be effectively making 60% returns by taking advantage of a 5% discount. Or even if you had to use a credit facility from someone like Finstro to take advantage of that after the cost of that credit facility, you can still be making a very high return on capital. So I just wanted to illustrate that. There's two interesting topics there. There's using business credit for the purposes of purchasing an asset which can be immediately expensed, I think can deliver positive tax paying businesses with tax savings. And then an interesting thing about early payment discounts, which when you assess the returns associated with it, something which suppliers should try and avoid, and in fact, something which buyers should try and capitalize on. So I'm happy to take any questions.
We haven't had too much to come through, but I'm guessing can you just outline if people have scenarios they want to run, how's the best contact? And then also maybe from an accreditation point of view, obviously we've got different members with different aggregators. Is there direct accreditation off panel available through you guys?
Yeah, so Paul Murray is our executive that looks after our financial intermediary networks. And so we do have an accreditation process. It's relatively straightforward and would welcome the opportunity to deal with any of your members.
Perfect. Well, thanks for that, Brad. Nothing's come through as such as direct questions, but if you need or you have any specific questions about scenarios, guys, please reach out direct to these people and to run scenarios or any questions that you might have that you want to take offline. So thanks for that, Brad. Next up,
thanks, guys.
Casey from Affordable Staff. And Casey will be talking and presenting on business benefits of outsourcing. So over to you, Casey.
Awesome, thank you. Good afternoon, everyone. Let me just quickly share my screen. Awesome, I now want to jump onto the wrong screen. Give me a second. Awesome. No, that's not sharing anything now. Sorry, guys. Okay, can everyone see my screen now? Are we good with that? That's working?
Perfect.
Awesome. Cool. Well, good afternoon, everyone. First of all, I'd just like to say thank you, everyone, for having me here. And again, hope everyone who's experiencing the flooding down there is at least trying to stay dry, and wishing you all the best. Now, I'm from Affordable Staff, and we're an outsourcing provider, but I won't be talking about the product today. I'm going to be talking about the business benefits of outsourcing. Now, one question I get a lot is, what is outsourcing? Now, for mortgage brokers, it's often needing assistance with loan submissions or just general admin, or it could be a combination of both. Now, there's two ways that typically a broker would go about outsourcing. It's either pay per file processing or a virtual assistant service. Now, the difference with that is, with a pay per file processing, it's great if you're looking for a quick temporary solution. So for example, maybe your business is picked up really quickly and you have a little bit too much on your plate that you really just need to offload somewhere else, then pay per file is excellent for that. However, as a long-term solution, using pay per file processing isn't as sustainable as a virtual assistant service. So especially if you're looking to grow your business, sustainability is key. Using a virtual assistant service really gives you the resource in your business that is there 24/7. So you can have someone there to prioritize tasks, and they have the ability to help you in more than one section of the process. So what are some of the benefits of outsourcing? Well, let me quickly introduce you to what I like to call the 4 S's. So save money, save time, see more clients, and systemize and create efficiencies. So save money. If you're looking to add resource to your business, the cost of using an offshore outsourcing provider is typically less than half the cost of an onshore team member. And if you were looking at it long-term in comparison to outsourcing using a pay-per-file service, an offshore outsourcing provider is still more cost-effective in long-term. Again, it's very customizable onto what the broker is looking for. If you're looking for something really short and quick, pay-per-file would be the way to go. But for those who are looking to upscale their business and you need something really long-term, an outsourcing virtual assistant provider would 100% be the way to go. Save time. Time is such a precious thing. I know I don't have a lot of it. We all want to take that time-consuming admin off our desk and into the hands of someone else. And outsourcing is the perfect way to do that. So spend more of your time what you do best. So for me, talking to people, having that client relationship is what I do best. I'm no good with an Excel spreadsheet. Ask me to do those tedious tasks and I'll be bored out my mind. So, going out and speaking with your clients, creating that new business, bringing in those leads, that is your job as the broker, building and maintaining those relationships. That's what's important. So outsource your admin. See more clients. Now that you've outsourced some admin, you've got it all off your desk, it gives you that opportunity to really expand your clientele. I really like to put it as, if you have $10, you want to be focusing on the $8 tasks. So the return of investment activities. And you want to delegate those $2 low value time consuming admin tasks to your offshore team member that you have outsourced through a virtual service provider. Now, there's one point on here that I really will go through a little bit, and I really like to highlight it because a lot of people don't look at and outsourcing an offshore team member in this typical way. So to systemize and create efficiencies. Outsourcing providers are experts in systems and processes. They're a great resource for brokers to access to really help scale their business better. Now, a lot of people will just see outsourcing as, okay, I'm getting a team member that's going to be working with me and helping me take some tasks off my hands. But not only are you getting a team member, you're also getting a whole business that has a lot of resource and a lot there to actually help you. You don't just get a team member, you get a whole support system that you can really sink your teeth into and help you scale your business, as well as you're getting your team member who would help you scale your business and take some time off your hands. Now, it's really brief today because, again, I'm talking about the benefits of outsourcing. So it's all really what you want to do. Outsourcing is a great way to really take all of those tasks off your desk and to help you scale your business. It doesn't always have to be scaling your business. Maybe you want to take the back foot and you want to have a holiday. Outsourcing is another great way to do that, because you would have someone there to do those tasks for you while you're off on holidays. Caitlin is probably a face you're all very familiar with. She's typically up here today. However, she is taking a holiday because she has an outsourced offshore team member who has stepped in, doing all her admin, watching her inbox, answering the phone calls, and she's off having a very much deserved break. Now, I'm always more than happy to have a chat. If you want to know more about outsourcing, its benefits, how it works, my details are up on the screen there. We do have myself and Caitlin who work in the mortgage broking space. However, whoever you'd like to contact, one of us will be more than happy to run you through a few things. And that's me for today. Does anyone have any questions at all?
Nothing's necessarily come through on the chat, but I guess my biggest two takeaways from what you just said then were all about outsourcing tasks that you don't like doing and making more time to be able to do tasks that create more money or turn the dial. Is that sort of the two main points?
That's 100% I guess the view I like to push is, you want to be everyone wants to scale their business. Everyone wants to make more money. So you want to focus on doing those things that will allow you to do that. Once you hit a certain capacity, you've hit that capacity. You need to add a resource in there in order to expand your capacity. So if you outsource, especially like an offshore team member, then they can be handling all those really time-consuming tasks. And then that clears up your schedule a bit more to then be focusing on getting new leads and maintaining your client relationships. So 100%.
Sure. And the space that Affordable Staff play in is virtual assistants. And do you also do per file, or is that not a space that you guys play in?
No, so we only do work in the space of we provide a offshore virtual assistant. Unfortunately, we don't do per file. But there are plenty of other resources out there that are great for per file processing. But Affordable Staff, we specifically just work in providing a full-time dedicated team member.
Perfect. Well, I can definitely resonate with all of that. We've taken on some new staff here onshore, and definitely has not been the smoothest or easiest of processes. So I can definitely feel anyone's pain who's doing that. So if anyone needs any assistance or wants to chat about outsourcing, please guys feel free to reach out to Affordable Staff. So moving along, we are running a little bit behind schedule, but we'll try and get it back on track. We might be a couple of minutes over, but I don't think that's going to be too bad. There's some good content coming through. Amelia from Credit Fix Solutions. So Amelia will be talking to us today about why credit repair is an essential tool for us as brokers. So over to you, Amelia.
Thanks, Paul. I'll just share my screen. One sec. All right. Can everyone see the screen?
We've got audio and visual. Perfect.
Excellent. Thank you so much. I hope everyone's well and again doing okay in the floods. I'm here in Sydney too, but lucky not to be affected. Just thought I'd jump on today, as Paul mentioned, to discuss why credit repair is an essential tool for brokers and for yourselves. So I've put a couple of points here why I believe that it is an essential tool, and it's also part of our company philosophy as well. So for example, time is money. More loans will be written by you. So for an example, you've got a client who's got a default on their credit report. You can't get them financed due to these adverse on their file. If the client goes and does it themselves, a lot of clients actually don't know how to do it, and they don't know what steps to take in order to get their file fixed up. So instead of doing that, you can give them the option of coming to us and say, well, look, we can do it in this time frame for you, which will speed the process up. So we can take them on 3 to 8 weeks usually, get it done for you, send the client back to you, boom, you can take them to get that loan done. So time is really important for you guys. So that's an option there that you can provide for your clients. Similarly, with like building brand and credibility, giving the consumer an option. So like I said before, if they've got a default on their file, maybe you can get them with one lender. But if you give them the option of credit repair, then they'll look at it and they'll be like, oh, okay, this broker really cares about about me and really wants the best scenario to happen. Because when you go, say, for example, with credit repair, you've got all those options. You might have more options once the default or repayment history gets amended. So the client is more likely to be like, oh, okay, I'm being looked after, and stay with you. And as I've got in the next point there as well, clients are more savvy and are inclined to shop around. If you don't give them those options, to proceed with that, they might be like, oh, okay, I'm not being looked after by that person, I'm going to go and find another broker. So giving them those options actually creates retention, as my next point is. The client is more likely to come back to you if they're likely to realize that you're doing all you can to help them improve that and to get them the better interest rates, or to get them into the lender they would like. So it's really, really important to make sure that you're giving them options and everything that they can do, either one lender, going to credit repair, giving them those options. But yeah, retention definitely. If you have that relationship with the client and they know that you're there looking after them, you're giving them all those options, they're likely to go to their family and friends and say, hey, look, I've spoken to this broker. They looked after me so well. They gave me everything I can do. I really recommend them. So it's bringing that customer back and also getting that customer to chat about you to other people, getting more clients in. So yeah, that's why I believe that credit repair is an essential tool for brokers. But if you had any questions, you can contact me. My details are on the front page. And yeah, thank you.
Perfect. Thanks for that, Amelia. And Victoria is definitely a proud supporter of the FBAA, being on the council as well. So anyone who needs anything, please reach out direct, because obviously everyone's situation is going to be slightly different, and they definitely have run scenarios and have done for me so in the past as well. So thank you very much, Amelia. Next, we're moving on to Angus from OptiPay, who'll be presenting on how trade finance works for small business. So over to you, Angus.
Thanks, Paul, and hi to everyone. Yeah, I'm down here in rainy Sydney, so yeah, it's pretty miserable weather for everyone at the moment, but I hope everyone's doing okay. Look, I'm understanding we're running a bit late, so I'll whip through this pretty quickly. So I've just been asked to put a small presentation together around cash flow funding solutions. I'll just share my screen. Let me know when that comes through. Is that good, Paul?
Yep, that's all good.
Okay, so OptiPay is my business. We provide cash flow funding solutions for small businesses in Australia, all over Australia, specifically in the invoice finance and trade finance solutions. Today, I'm going to talk about just trade finance. But before we do that, we'll talk about what type of businesses typically, the typical cash flow issues faced by SMEs. So when a new client or prospective client comes to us, typically what they're trying to do is unlock their cash that's tied up in their receivables ledger, and or access cash to pay for inventory and other supplies that they need in their production cycle. So the challenges that all small businesses face, and all businesses generally, is that customer payment terms result in the cash flow squeeze due to the mismatch in timing between having to pay for supplies and getting paid by your buyers, the business's buyers, for their goods or services. So it's a pretty common issue that all businesses face. And as a result, they're unable to grow their business due to working capital constraints. So obviously what we're trying to do with cash flow solutions is to unlock either cash to pay suppliers or cash from their unpaid invoices. The costs and dangers of cash flow constraints on businesses is significant, and a lot of people don't even don't think it through. But basically, if you're on a chronic squeeze on cash flow constantly, you're unable to take new opportunities, difficulty in paying suppliers or contractors, which results in abusive phone calls and other issues, risk and impact of uninsured debtors' failure to pay, growing Ato debt. And what we've seen in the last 6 or 8 weeks, as you've probably seen in the press, I've been on ABC News and other 2GB radio last week talking about the issue with the Ato. They've now come back collecting. So for 2 years during COVID, the Ato didn't collect debt. So most businesses just racked up they didn't pay PAYG and GST. That's now changed. Ironically, we're in a far worse economic position than we were 2 years ago. So businesses are going to be in very cash constrained positions going forward. On that again. And suppliers that may result in suppliers cutting off their credit terms or ceasing supply totally, which is the worst case scenario that you could have as a business, because if you're unable to get your supplies, obviously this leads to mental and emotional impact, leading to low productivity for their business. So they're the factors that contribute as a result of cash flow constraints. And as we know, 84% of Australian businesses fail due to poor cash flow management. And to be honest, traditional funding is part of the problem. Banks are restrictive. If you've ever dealt with banks, and I know you all have, it is hard to get a deal over the line. In cash flow lending, mortgages might be a bit different, but in cash flow lending, generally takes between 3 and 9 months to get a deal done. If they haven't got a tax debt, they're pretty much not interested. Lots of red tape, restrictive covenants, overdrafts are limited and don't increase with you. If you're able to get 100, 200 grand overdraft for your business clients, typically to go back and get that, go from 100 to 500 is very difficult. And then generally want house or property as security. And obviously with loans, they've got to be repaid. So the business owner has to factor in the repayments each week, month, fortnight or monthly. So 2 solutions, trade finance and invoice finance. What's the difference? So trade finance is a form of finance that assists a business, our client, to pay for goods from that they buy from their suppliers, both domestic and international. So trade finance assists with supply side of a business. Invoice finance is a form of finance that assists a business, our client, to bring forward the cash that's owed to them from their customers for goods or services they have sold to their customers on credit terms. So invoice finance assists with the sales side of a business. So yeah, this is pretty basic stuff, but trade finance works on the left side of a business. Invoice finance works on the right side of a client's business. And I use those terms left and right, supply and sales. And typically most of our clients have both. They've got a trade finance facility as well as an invoice finance facility, and they work hand in hand. So we help pay their supplier. They get 90 days, pay us back. Goods come into Australia. They ship to their buyer. The buyer then might have 60-day credit terms. So it might end up being, by the time they ship it from China or Europe or wherever they're coming in, 180 days before they see the money for this transaction. So having both a trade and an invoice financing facility can assist the business there. So trade finance, how does it work? Trade finance is a form of finance that assists, we just went through that, to pay for their suppliers. They typically come in 2 forms, either letters of credit issued by the importer's bank to the exporter's bank, which guarantees payment to be released once the terms of the LC, the letter of credit, are met. The banks will often use LCs for their larger trade finance clients. What the non-bank lenders such as OptiPay does is we'll use a revolving debt facility. So how that works is where the financier will pay a percentage of the supplier's invoice, up to 85% typically. If it's China, they typically want a 30% deposit before they manufacture anything. The client will pay that. When the goods are ready for shipping, we'll then pay the 70% remaining amount directly to the supplier in USD, Euro, AUD, whatever it might be. Our client then has up to 120 days to repay that loan. And this allows them time to ship the goods to Australia, do anything they're doing to it, which may be none. It might just be repackaging, might even be that, might be shipped straight to buyer to deliver their buyer. If that buyer then has a 30, 60 or 90-day credit term on that purchase, that's when invoice finance will then come in and help them pay back the trade. And our 2 facilities work hand in hand together there. So look, that's very, very quickly what trade finance is and what type of businesses might use it. Happy to open the floor to any questions if there are any, Paul.
Nothing's necessarily come through. So obviously for, say, a resi broker, this is all pretty new. If they're just thinking like, oh, how does all this work? Obviously, you guys will hold their hand through the first lot of transactions that we look at doing. Is that sort of how it works? Yeah, correct. So, and I fully appreciate if you're a resi mortgage broker, moving into this cash flow funding for businesses, for your business clients, if you have any, is a different step. I 100% understand that and accept that. So, yeah, absolutely, we can walk you through. If you've just got a scenario and you're not even sure whether what might work or if it will work, my contact, you can get my contact details through the FBAA website. Just ring me up. I'm happy to walk you through, answer any questions and say, yeah, look, that's something that can work, and that's trade finance would work there or it won't, or invoice finance might work there. So more than happy to do that. Perfect. Thanks. No, pleasure. Thanks for having me.
The reverse mortgage market from the FBAA side, about 4 years ago, looked at what it was looking at, well, the stance that was coming along, and decided that they'd like to support the industry. They set up a subcommittee, and part of that subcommittee role is to get brokers and lenders together and to work as an industry body, small that it may be, for this particular sector as such. So what is a reverse mortgage? Principally, it still is a home loan, and it's covered by NCCP Part 1, but specifically Part 2, which was legislation 3 years later, which had special requirements for reverse mortgages for greater consumer protections. From a variety perspective, there are a number of varieties in equity lease and reverse mortgages. The normal or the best structured loan is one which has 3 components which can be structured in any way. So you can have a lump sum, you can have an income stream, and a line of credit, all within a facility as such. And the reason for that is that would look at current needs and also look at any future needs that may be required further down the track. So a combination of those will give consumers confidence that whatever their needs may be, they'll be able to address those going forward. So residential security at the moment can be only occupied for investment. So it gives those people who've got investment properties the ability to have some debt placed against that or reduced asset position for any Centrelink entitlements. Special features. Sorry. As under legislation, special features include no negative equity guarantees, so the loan to be repaid can never be greater than the sale value of the security. All borrowers must receive independent legal advice on the terms and conditions, and that's important in terms that they fully understand that particular aspect of their borrowings. They must be provided a Money Smart calculator, which shows the use of funds. So the funds are, the calculator will show how the funds are accessed and what that would look like over a 5, 10 and 15-year projection, and gives people confidence to know they can pay for anything else down the track. They can pay for residential aged care, and they also have a capacity to provide an inheritance to family members or other beneficiaries. FBAA, as part of the development of the course, now requires all brokers to complete the equity release course prior to any loan writing. That course will be updated in the next 12 months to have greater information provided about Centrelink and aged care. So from an international market, and we look at the countries which may be relevant to us here in Australia, the UK has been dominant in the last 3 to 5 years. And last year they did just under $10 billion Australian in equity release for that market. And that $10 billion produced 1% of the economy, development of the economic development in the UK. They have multiple options, multiple products, multiple lenders, advisors, assessed on an annual basis through an assessment process. And it works very well under an association industry body which looks after that sector. In the USA, the total employed over there is about 15,000 people with about 950 facilitators, and still going very strong. In Canada, there's probably a standout market for the size of it. They currently have book values of about $5.5 million. Only one lender, but it's doing exceptionally well. So if you look at the comparable countries, Australia in itself would fit into those, and that's where we see the potential for development in here in Australia. From a historical perspective, the peak was in 2006, 2008, prior to GFC. We had 22 lenders, a book value of 4.3 billion. And when GFC came along, a lot of wholesale funders disappeared from the marketplace, and progressively over a period of time, major banks withdrew, leaving one non-bank lender. And since then, there's been a number of new entrants in the marketplace. Those entrants are primarily focusing on specialised brokers in the market, those who spend perhaps 30, 40, 50% of their or more of their credit facilities in that sector. There are more lenders coming. There's a new lender coming in the next 2 to 4 weeks, and there's another one which we believe will be around the corner or late this year. Let's say that at the moment. The other product which is available in the marketplace is called Home Equity Access Scheme. It's an ASIC's view on that. It's a government program, therefore it's not regulated by ASIC, but they are changing their opinion on that due to the best interest duty, that if the government reverse mortgage program best suits the client's needs, brokers should be able to have that discussion with the client to see if that's the way they wish to go. So out of the market itself, 78% of retirees own their own home, and 70% of retirees are either full or part pensioners. And 26% of people who go into retirement have some form of debt. And predominantly that would be the credit card debt or home loan debt. The government policy is now starting to encourage retirees to access equity through various forms. They've revamped their home equity access scheme, which was primarily a fortnightly payment. Now it's gone to a small but available lump sum of about $12,000 to $18,000 a year for those people who have got minor requirements. The Retirement Income Review in 2019 stated that equity release should form the third pillar of retirement income, in addition to the first one, superannuation, of course, and the other one, age pension entitlements. And more retirees are now looking at the current income costs and finding that their income is not meeting those cost of living needs. What are the options for equity release? So the first one is downsizing, where some people might move from a $2 million house down to an apartment with 1.4, and it's probably more Sydney and Melbourne sort of example. But the funds under downsizing provisions, up to $300,000 per person can be placed into superannuation. So the example of $2 million down to 1.4, 600,000 left, 300,000 each can go into super. The disadvantage of that is that you've got a loss of high growth on the $2 million property, but super becomes an assessable asset for age pension. And if you've got 600,000 there and you've already got 300 in super, basically you'll lose all pension entitlement. So someone who's got 300 in super as a couple at the moment, got $38,000 in age pension entitlement. They could lose all of that by putting the rest of the money into super. The other options are to return to work, and there's not too many people in the 70s who want to return to work, and they can sell other assets that they have. So they happen to have an investment property, flat, unit, apartment, whatever it may be, they could sell that. One of the things that they don't want to do is borrow from family or friends. And the last one is the government equity release reverse mortgage product. The fact find preliminary assessment, do the clients, potential borrowers, do they qualify by age and location? Most of those are from 60 years upwards, and all capital cities, major regionals, and there is one or two lenders who will do some far-flung location postcodes. First thing that I would normally check would be, are they receiving the correct age pension income? And the example I normally give were some clients 2 years ago who'd been getting about $118 a fortnight, and I had a look at their assets and income, and I thought they should be getting $513. And chap said, no, look, I'm fine. I'll go on to MyGov every time and sell some shares and downgrade it. But what he didn't do, he put the data in but didn't save it. So they lost over $30,000 over 3 years in age pension entitlement just by not correcting that data input. And it's important to make sure that if the data is correct and we know what they earn and it is correct, then we can work on what their needs going forward. The primary purposes of reverse mortgage these days are refinancing existing debt, pay for a car, renovations, travel, gifting, and meet cost of living needs. And gifting is an interesting one because once again, I'll go back to the Centrelink side of it. Gifting is an assessable asset, or the deprived asset as they call it. So any gifting is over $10,000 is assessed by Centrelink for the following 5 years. So it may have an effect on those people currently getting part pensions or full pensions, depending on the amount of gifting, that may affect their age pension entitlements. In 2018, ASIC released its regulatory guide 586 on reverse mortgages and found most were achieving their current needs of borrowers, but very little assessment of future needs was taking place. So an example was, but most borrowers weren't questioned or spoken to in regard to future repairs and maintenance, ageing in place, the healthcare, funeral costs, in-home care, and residential aged care. And there's some of the things that perhaps specialised information from an advisor's perspective, from a broker perspective, having understanding about those. So you can talk about perhaps a line of credit to cover some of those, and the calculator will show the benefit of what retained equity is retained to meet, say, residential aged care as an example. So when we look at the later life cares, we do look at things like care at home and leaving inheritance and receiving resi care. So in-home care, government provides between $9,000 and $52,000 a year for services at home, and most consumers would only pay about $3,800 towards that. So there's a whole range of services the government pays for, the taxpayer pays for. Resi care is a little bit different. If you've got a home, you'll be gauged as having capacity to contribute to care and accommodation, and the balance of that, therefore, is afterwards is paid by government. So government still pays somewhere between 70 and 75% of all aged care. Consumers just need to contribute when they have assets below above a certain threshold, about 178,000. This example is a lady who wanted to take $50,000 out, and in using the example here, we're showing what the net equity position will be if she took a growth of 3%, current interest rate, let's say an average of 5.8%. In 10 years' time, at the age of 82, she's accessed probably around about $100,000. The net equity in the property would be about 885, somewhere around about there, 3% growth based on that. And if you're looking at where she is at the moment, it's almost exactly what her home equity position is when she takes the loan out. That's based on a 3% capital growth and a current interest rate of 5.8%. This is the calculator that ASIC requires all borrowers to receive. And if we look at the second calculator, here it says if the interest rate was 2% higher for the whole period of time, this is what the position would be. So effectively, let's say at the age of 82, at the moment, she in 10 years' time, higher interest rate, she'd have 80% equity, and if interest rates stay the same, it could be 82%. So it's not such a drawdown on net equity position by 2% higher. Independent legal advice is mandatory, so all borrowers have to see a solicitor to receive independent legal advice on the terms and conditions of the mortgage documents, and it's an ideal time to have a discussion with the solicitor and reinforce the potential for borrowers to update wills or actually do new wills and enduring powers of attorney, and have a discussion about what those mean, whether financial, legal or medical, and advanced care directives which go along with the medical enduring power of attorney. If brokers find a reverse mortgage inquiry has specific knowledge and requirements outside their expertise, special advisors are available in WA. Scott Gillespie from Reverse Mortgage Finance Solutions will be able to assist, and that's his email address as such there. And that's all for today. If there's any questions, please, Nick.
So moving along, we're going to move on to Pepper Money, and Ben from Pepper Money will be talking about commercial property purchasing versus renting. So over to you, Ben.
Thank you very much, and good afternoon, everyone. Thank you for your time. Just be giving a bit of an overview on buying versus leasing commercial property. So in the current market that we're at, look, we know, well, we don't know, but some of the economists are saying that, house properties will drop. So now's a time where, a lot of customers would be looking at diversifying their property portfolio and may look at purchasing commercial. And, we do see an opportunity in the commercial property market in the coming, months to a year. So we just want to give you a bit of an overview on buying versus leasing, the pros and cons. So when we look at buying versus leasing commercial property, in terms of the advantages, so if you've got a customer, when they buy their commercial property, whether it's a self-employed client who's operating a business, they may want to purchase a property where they're operating. If they, buy their own commercial property themselves, or even a PAYG property investor, then they can always sell the property. They've got control over, any changes, and it can really, simplify the financial planning for either the self-employed customer or the PAYG property investor. In terms of the disadvantages of buying commercial property, obviously there's a large upfront cost, that goes into the initial acquisition of the property. There is, limited, flexibility. And what I mean by that is if it's a business customer where they're buying a commercial property, perhaps they may grow in 5 years' time and they may need a bigger property. They might not have forecasted that. So there is limited flexibility in that. And then it's the ongoing cost of actually, maintaining, that commercial property that they have themselves for any, repairs, fixtures, improvements. In terms of leasing, so the advantages, for leasing a commercial property, especially for, the self-employed client, it gives them lots of flexibility. They can do a fit out on the property, on the internal, improvements of that property, on how they would like, to fit for their business model. Plenty of capital is freed up. And also, if the business does grow, they can also move once their lease is finished. They can move and rent another property to suit their needs. In terms of the disadvantages, though, for a client or a business customer who would decide to rent, look, rents do rise, so there's no certainty in that. The landlord can always, sell that property. So, you might have some client where they just want to rent for the rest of their business life. And they're happy with their location. They've got great, foot traffic that comes through. Maybe the landlord sells and that could disrupt the business plans. And then also you'll be paying somebody else's mortgage, if you're renting. That's one of the disadvantages there as well. In terms of, looking at Pepper Commercial Solutions, look, we've got loans up to 3 mil. The types of clients, you've got your business owners, self-employed. So look into your own database as a mortgage broker. Look at your self-employed clients. If you notice any of your customers on their financial statements where they're paying rent, perhaps ask them the question, have they thought of buying their own commercial property? Or, alternatively, it could be, self-managed super fund, where you've got a client that may want to buy a property in the commercial super fund. So just always ask the question, or if you have a property investor on your books where they've got a large residential property portfolio, perhaps they haven't got a commercial property in there. So, maybe pose a question if they're looking to diversify their property portfolio and look into the commercial market, because the rental yields are generally a lot more attractive than residential. So in terms of Pepper difference, look, top 10 why you would deal with us. You deal directly with the credit managers. Our accounts have, offset accounts, redraw. You own your own customer relationship. And any support on any commercial scenarios, as always, reach out to your commercial BDM. If you don't know who your commercial BDM is, look, I'm based in New South Wales, cover various aggregators, but you can always reach out to myself, or even your residential BDM that you deal with at Pepper. Reach out to them, and they can refer you to the right area to speak to. Also, what's coming up for Pepper? We've got our Insights live on the 27th of July at the end of this month. Had great success and great feedback from brokers and aggregators alike and members such as FBAA. So please, if you're interested, register and get involved. Thanks for your time.
Just stay there, Ben. There's a couple of questions. So one's just come through. Does Pepper do self-managed super fund lending?
No, we don't.
Okay. And in terms of accreditation wise, if I'm accredited as say a resi broker, am I automatically accredited in the commercial space as well?
No, you won't be automatically accredited for commercial. With the commercial accreditation, we do make it very easy to do business with. Once there is a application or scenario on the go, we will arrange the accreditation for you.
Perfect. And someone's just messaged in, sorry. So for scenarios or someone to talk to, is it best just to reach out to the commercial BDM in their particular state or under their aggregator?
Correct. Yep, definitely.
Perfect.
And then if you don't know who your commercial BDM is, just reach out to your resi BDM, because there's, for an example, there's 2 commercial BDMs in New South Wales, but we are aligned to aggregators. So if you don't know who the commercial BDM is, just reach out to your residential Pepper, BDM, and that they can guide you.
Perfect. Awesome. Thanks for that, Ben.
Thank you.
Next, we'll be moving on to AmFin, and Phoebe from AmFin will be discussing, presenting on looking outside the box for commercial asset lending. So over to you, Phoebe.
Fantastic. Thank you so much for having me, guys. So today I'm going to be presenting on looking outside the box for commercial asset lending, and I'm the dedicated New South Wales and ACT relationship manager here. I'm sure we've met face to face at some of the most recent events. I've only got 5 minutes, so I'll keep it pretty short and snappy for you, and my details will be at the end if you've got any questions and want to catch up. We've also got the chat function as well. So to kick us off, we're going to have a quick look about the 4 ways we can look differently at commercial lending. And the first is asset sourcing. This is a fantastic way for you to keep the deal in-house and also deliver the best and holistic customer experience for your clients. The second way is with deposits and balloons and how we can rethink them, especially in the current climate of rates and LVR considerations. The third one is, oh, geez, sorry, lost my screen. Sorry, guys, tech issues. What's going on?
Speedy.
Sorry. The whole presentation just shut on me.
You can always just wing it, surely.
I definitely can. Won't be 2 seconds. Here we are. Sorry, I know we're running behind time already.
No stress. I can pick it up on the back end. I'll just cut some of my stuff out. It's all good.
Sorry.
Oh, it's fine. It's all good.
All right, where are we? Take 2. All right, is that all good? We see it?
We've still just got you at this day. Here we go.
There we go. All right, back to where we left off. The third one is with regards to weighing up the difference between leasing and purchasing an asset for your client. And then the fourth one is with regards to thinking about each business's life cycle and the goals that they're at, not just their immediate need and the current interest rates. There can often be different ways of setting up finance and a work that can be done up front now to best support your client and set them up as they grow and evolve their business as well. So to kick us off, we'll look at asset financing to start. The key with asset finance is asset sourcing, is that you will completely remove the dealer from the competition. So you won't need to worry about your client being anchored with a fake rate issued by the dealer, where they often build the cost of financing into the vehicle sale price. You can introduce asset sourcing as a service up front with your client so that you can keep them away from the dealer altogether. And then the dealers that they do see are actually on your side and working with you. With the current asset delays, which I'm sure you've all kind of heard about or been impacted by, you'll also be able to better assist your client by hopefully bringing car delivery forward. There are several occasions where our clients have had a 12-month wait time originally, and then we've been able to find them a car within 3 months. So asset sourcing can be valuable in delivering on needs and also building trust with your clients in a new way. Another great benefit of asset sourcing is you won't be at the mercy of a dealership when it comes to securing the invoice for settlement. The second one is deposits and balloons, and they can be really critical to be competitive on. So sometimes your clients will want to minimize the initial outlay, which you can manage through lower deposits and higher balloons. Alternatively, if your client is short on a deposit, rather than just saying no to the deal due to them not having the right amount required in cash, you could also look to see whether they would service for both an unsecured cash loan and also the asset finance. Cash flow lending can be approved and settled within 24 to 48 hours. So it's actually a really handy way to problem solve for your client. It's also important to look at repayments and not just rates. I'll explain a little later on the minimal difference rates can make over the life cycle of an asset loan. So use repayments as the measure of success, and then you can adjust them based on the deposit and balloon amounts that you recommend for the client. Finally, you can use balloons to refinance assets later on based on short-term and long-term business objectives. Your client may want the loan at a higher rate now and then put in more balloon at the end to minimize the interest that they're actually paying, knowing that you're probably going to refinance within 2 years anyway when they're eligible for a more competitive loan construct. Thirdly, leases versus purchasing. Often clients forget about the option to lease an asset instead of financing it completely. With end of financial year, naturally, it's brought to mind assets being used as a business write-off or a depreciation benefit. If this is the case, then purchasing is exactly what your client needs. However, sometimes a lease can be best when dealing with specialised equipment and machinery that actually costs more to remove than it's worth at the end of the term, for example, medical equipment. Infrastructure such as technology equipment may also be better for leasing, as the equipment can be harder to dispose of, might have higher maintenance and upgrade costs, as well as disposing of the asset can conflict with the company's green policy. Ultimately, the key thing to consider up front is, does your client want the asset as an operating expense? If so, a lease is a really good option. Or do they want the asset on the balance sheet at the end of the term for accounting purposes, in which case asset finance might be more suitable for them. And then finally, to finish us off, we always really want to understand the client's long-term goals, not just their current transactional needs. The reason being that for new businesses or one who has gone through hardship, their current options may not be the best. So if we're able to restructure a loan after 1 to 2 years, we'll look at lenders with no or low early payout and termination fees to provide a cost-effective option when considering where we're going to finance. Specifically, there are lender options with policies for companies that are ABN registered for 1 day, 1 year, or 2 or more years, with significantly different rates and different offerings for businesses at the different stages. Working on what the business can afford at the time is really important, and interest paid is simply the cost of taking out the finance. As I mentioned earlier, I can neatly explain the monetary impact of an interest rate and how minimal it can really be. For example, the difference of 3% and a 3.5% rate on $50,000 is really actually only $250 over the 5-year term, which is $84 a year. Your client would be silly to refuse a rate and not take out finance with you over $84 when they could gain significant opportunities by acquiring the asset for business operations. So we always really want to focus on bringing the client back to reality, focusing on the operating costs, as well as what ROI they're going to get with the finance. Finally, when it comes to asset finance, there are so many options out there. Us at AmFin, we've got 84 lenders on the panel, and we've actually removed a couple recently as well. And when there's a will, there's often a way with commercial asset finance. We'd recommend don't go to the same places, use a referral partner, and uncover all of the options that are available for the client. Thank you so much. Do we have any questions?
Nothing direct, but I'd probably just have a couple there, Phoebe. So yeah. I've probably got intimate knowledge of AmFin, as in that I use them in my business for tick and flick. So obviously that's a method that you can use for both commercial and just normal lending as well, for like car loans and things like that. Tick and flick model is available for both.
Yeah, absolutely. So both consumer and commercial. And we also have tick and flick for asset and for cash flow. So essentially anything that your client needs, tick and flick's the way to go.
Perfect. And in terms of dedicated BDMs, do all aggregators that you deal with have dedicated BDMs, or who do we reach out to in the first instance? If we've never used AmFin before, how do we reach out?
Give me a call. My details are on the screen now. The accreditation is super easy. It's literally 1 page to fill in. We'll do a quick onboarding session, which is very much one-on-one, us understanding your business, and then you'll be good to go.
Perfect. Thanks so much, Phoebe and AmFin. Thank you very much.
Thanks for having me.
Perfect. So moving a little bit along, guys, we've pretty much pulled it back on time, and I'll just wrap up my little bit at the end and keep that a bit shorter. But obviously all the presenters today had some very valuable content that we can all use and help us in the future. Just so everyone's aware, us as the state councillors and me as the state president are always available for anyone to chat to at any time. Our details are found on the FBAA website, so at any time please reach out. I know there's a few councillors on the meeting today as well. So just before we close off this Learn and Earn session 2, there are just a few quick notes. We'd like to recognise our national sponsors for their time. Without their support, we couldn't bring this all to you. We'd just like to thank our presenters for today: Lauren from Bluestone, Cameron from Strive Financial, Shelley from ALI, Brad from Finstro, Casey from Affordable Staff, Amelia from Credit Fix Solutions, Angus from Optipay, Paul from Team Australia Mortgage Solutions, Ben from Pepper Money, and Phoebe, lastly, from AmFin. You will be receiving an email after today's session with 1.5 CPD points and a short survey. Please fill out the survey. It does help us tailor these types of events, virtual, face-to-face, to make sure that we're giving you what you want. There are also webinar recordings on the FBAA YouTube channel, so please jump on and view those. Just to let you know about a few more upcoming events. We've got Q&A with Whitey, always very eventful, as Whitey goes off the cuff with a guest. The next one's on the 28th of July. Our last face-to-face event in Sydney will be, our last lap face-to-face event in Sydney will be on the 20th of September. There'll be some more information coming out, so just keep your eye out for the emails and on the events page on the FBAA. So thanks everyone for your time and support today. Stay safe, stay dry, and if you've been experiencing the floods, our thoughts are with you, and reach out to those people that you feel might need some assistance. Thanks everyone. Have a great day.